vaults, what's it in the vaults in the UK is supposed to be LBMA vaults, Bank of England vaults. It's supposed to be half of it's only half of it's central bank owned. So why is it taking this long? I mean, I could go in there tomorrow and unload a trolley load for an immediate delivery. Why would I have to wait all this time for what's supposed to be there? It's actually supposed to be there because they don't want to give it up. They just know that this is why what tells me something is going on. They're going to have to revalue. They're going to have to revalue it. That COMEX has to become Basel III compliant.
Andrew Maguire, a renowned British commodities trader and whistleblower who...
Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated. Join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pinned comment. Stay ahead of the curve. Don't miss out.
It's firm. Gold has been reclassified as a first-tier asset class. Now, how is it possible? How would it be plausible for one exchange, one global exchange, which the COMEX, the CME COMEX exchange, how is it plausible that that could be the only non-Basel III compliant physical exchange, gold, silver exchange, the US markets wanted to comply? Why did they? They could have complied. They split. And as we know, and really it was pretty clear, when the Bank of International Settlements squared all their last 500 tons on the 3rd of November 2011, just 2 months before they revalued gold as a first-tier asset class. So they're now zero. And the only borrowers, the only people that continued to borrow physical gold from the Bank of International Settlements, the Bank of England, have been the Fed. Now, why would they do that? Why, when every single global facing exchange is compliant, why is it when every single bullion bank, and we connect with some of the best top first-tier liquidity providers, as you do, they're all long for their own book. So how would it be possible, is the question in my mind, that for them to exist even this far in, where you see a price that's being generated by a very dilutive paper market where manipulation has been rife for 50 plus years, and simply because it was possible, because it was a paper settled market, cartels could operate, it would be settled amongst their books, and the resulting price ended up being the accepted global price. Well, of course, every other central bank is looking at that and preying on it. So, of course, so I think the reason that this manipulation that we have historically seen provided a lot of evidence to the CFTC, the DOJ over years. In fact, I can send you the link for the Russian television interview we did, where Bart Chilton admitted that we had reopened the closed down silver investigation, leading to the actual imprisonment and fines, close to $1 billion fine for JP Morgan and some of these actors. But the thing is, I think what I'm trying to say is, while all that's happening, in this meantime, everyone else has gone, right, I'll tell you what, that's cheap. That's not the real price. Why don't I just come and take it? And we had evidence, and in fact, in my last episode, I provided that we had 2 proxy buyers that we personally know had both stood for their 6,000 lot COMEX limit, the full amount that they were allowed to take, 18.6 tons, whatever it is. And they weren't the only ones. They cannot be the only ones. So I think, in a long story short, it's being sorted by this manipulation has to disappear, because the gold is flowing out on a one-way journey at a huge discount into all the other global exchanges, sovereign buyers, central bank buyers, institutional buyers.
Over the past 2 months, 12.2 million troy ounces of gold have been delivered to COMEX-approved warehouses, increasing their total stock by 70% to 29.8 million ounces, the highest since August 2022. This unusual surge in gold shipments to New York has drawn the attention of the British Parliament's Treasury Committee. During a recent session, a committee member questioned Bank of England Governor Andrew Bailey about potential risks associated with this trend. The large movement of gold to the U.S. has reduced the amount of freely available metal in London vaults, gold that is not owned by central banks or allocated to physically backed exchange-traded funds. This tightening supply has increased demand among London market participants willing to lease their gold for the over-the-counter market, further straining liquidity. According to commodities expert Andrew Maguire, ETF outflows and COMEX withdrawals co-occur, often explained by speculation around potential U.S. tariffs. However, he argues that the underlying issue is the depletion of available paper gold. The widening exchange for physical, EFP spreads, indicates that physical demand is steadily draining the paper market's ability to settle contracts. As gold increasingly moves from paper-based trading to physical ownership, the long-standing structure of gold price suppression through speculative derivatives may reach its limits. Let's get back to the interview.
Well, I think what we're looking at from the bigger picture is we're now looking at the US becoming a part, from gold and silver is concerned, a part of the global reset that we're seeing now. And they've been like an anchor trying to fight this all the way. And I think we just reached the point where there's too much technology coming in now. There's the ability to value the gold price is being revalued globally. And that liquidity that you and I have tracked this for so long, that liquidity that was partially paper centric has been flowing ever so slowly, one day by day, month by month, year by year, to the point where the lines have crossed and where the price is being settled in the physical markets now. So it's impossible to not comply. And I think, so yes, I think this is the next step. So I think, you've talked about ETF outflows. Yeah. And that's concurrent with COMEX outflows. And people talk about, well, look, yes, it's all to do with tariffs. And, we've seen these big EFP spreads. And no, the EFP spreads is simply because the paper markets are getting drained. Fantastic amount of, I make 5 o'clock in the morning phone calls to all my Asian desks, Chinese contacts, Indian contacts, Saudi contacts, et cetera, and these desks, just every morning they say, hey, we're buying. Hey, guess what? The West's going to sell later. I think we saw that again today. West's going to sell at the pit open. And guess what? We're just going to grab it. And so we've seen this ridiculousness, this absolute, to mind-boggling stupidness where Asia buys most of the open interest, the COMEX open interest, where you could go fool enough people to buy into that, sell short with you, pull a few bids, get them to take some profits quickly. Oh goodness me, we're going into hell in a hell basket. So I think while that has been going on, then literally that open interest, the 75% of, we talked about it, I think Bloomberg talked about it in the past, where they've actually said 75% of all the oil traders really control that market. It's just pure speculation. It's why we got the volatility. Same guys that are running the gold and silver markets historically. It's just momentum traders, like 75, they don't care what the price is. It doesn't matter. They're not ever going to take delivery. It's nothing to do with them. This is just a paper trade. These guys have anchored their boat to Bitcoin. To me, there's just not enough of these guys to take that bait anymore. And I think, so yeah, these guys are laughing their heads off and say to me in the 5, hey, we'll keep buying, but we're going to save some dry powder for when the West opens.